Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Edmond. Alan, I've been writing weekly options on Ulta Beauty Inc., ticker ULTA. On November 12th, I sold the $315 strike, November 16th expiration option. The stock price was $308.50. And on Thursday, prior to expiration Friday, the value of that option declined to 10% of the sale value and was deep out of the money. The stock price was $309.15. Should I buy to close the option and sell the next week's option on Thursday or Friday, or allow the option to expire worthless and then write the new option the following Monday? How much time value would I lose if I waited until Monday to sell the new call option? And it's signed Edmond. Okay, so the question is, when using weekly options, should we roll the option, even if the option is out of the money, to get additional time value on the next week's call option? So that's basically the essence of the question. Let's have an overview of Edmond's trades. On November 12th, the 315 call option for ULTA was sold, 1 week call option, expiring on November 16th. At the time, the stock was priced at $308.50. So the 315 call was an out-of-the-money call. On Thursday the 15th, the day prior to expiration Friday, the stock was priced a little bit higher at $309.15. However, the value of the option had dropped to 10% or less of the original sale value. Edmond didn't share the specifics of the option values, but it doesn't really matter. But it did meet the 10% guideline in the BCI methodology. So the question is, to roll or not to roll? Should you roll the option on Thursday or Friday to get additional time value premium on the next week's call option? Or do we allow the 315 strike to expire worthless? All right, let's have a look at a chart now and get a graphic view of this trade, and actually added one component unrelated to Edmond's trade in question, but I'll bring that in anyway because the opportunity presents itself. Let's start by the trade. On the top left box, you see that on the 12th, Ulta was priced at $308.50, and the arrow on the top left shows that the call was sold at $315 strike price. So that's where the initial weekly option was sold and the price of the stock at that point in time. Now the middle box shows that on the 15th, Thursday before the expiration Friday, that the stock price had moved up a little bit to $309.15, but the option value, because of theta or time value erosion, and the expiration was the next day, had declined to 10% or less of the original sale value of the 315 call option, which does meet the BCI methodology as to when to buy back an option in the latter part of a contract. Okay, so that's a graphic view of Edmond's trade. Now, this is unrelated to the trade, but I'm going to jump in here anyway and show you that the yellow field highlights the damage that a disappointing earnings report can do to our covered call and put selling trades. And you could see the humongous decline in share value that took place as a result of a disappointing earnings report. And that's in that yellow field on the right side of the screenshot. And this is unrelated to Edmond's trade or question because it happened after contract expiration. All right, but since it was there on the graph, I decided that I would highlight it and then mention it during this video. All right, let's then move on and discuss the factors that determine our rolling options. You know, how do we determine whether or not we should roll an option? Well, number one, rolling really applies to in-the-money strikes. And does that apply in this case? No, it does not apply. The 315 strike is well out of the money, with the stock trading more than $5 lower than the strike price that was originally sold. So that does not apply, and that's very important. Now, we also roll options when we want to retain the underlying shares. But again, that usually relates to in-the-money strikes when the option is most likely to be exercised. So do we want to retain the shares? Based on the question, it does imply that Edmond did want to retain these shares. Okay, so now the important part here is, will the time value benefit, if any, exceed the additional cost to close? Because when we close an option, there is going to be somewhat of a time value component to it, plus another trading commission. So will the time value benefit of selling the option for the following week on Thursday or Friday exceed that cost to close, which contains time value closing the initial option and the commission associated with that closing? Okie doke. So now we're going to move on and explain how theta works, and that will kind of give light, I hope, to the question and provide a reasonable response to Edmond's question. Theta is the Greek for time value erosion, and we know that as time progresses, the time value component, all other things being equal, will decline every calendar day. Now, time value, in essence, because it's by calendar day, is calculated for seven calendar days, but over a 5-day period, Monday to Friday, 5 trading days, and 7 days worth of theta is calculated over those 5 days. Now, when are Saturday and Sunday time value components deducted from these premiums based on the market maker's assessment? And the answer is, they are not deducted over the weekend. They're deducted Monday to Friday and prior to the weekend. So market makers will deduct theta components for the weekend on the Thursday or Friday prior to the weekend. So that means that there's very little penalty, if any, waiting until Monday to sell the next week's call option. So if that's the case, then there's no reason to spend the money on Thursday or Friday to close the initial trade. Assuming now, again, that the strike is out of the money, which it was out of the money by more than $5 in this particular situation. Also, weekend risk will be mitigated somewhat. I mean, we're not locked into the current market value on Thursday or Friday. What if the price of the stock goes up over the weekend? We could take advantage of that and then sell the weekly option on Monday based on that new value. Now, of course, the value can also go down, but then we could still sell the option and generate a similar time value profit based on the new price of that stock. So the takeaway here is related to when the market makers deduct the time value component of the premium as expiration Friday is approaching prior to the weekend. So just let's summarize all that right now. And we say that rolling deep out of the money call options, as was the case here, the 315 strike was deep, more than $5 out of the money. It really makes no sense. It's really not to our advantage to do so. We're spending money really unnecessarily here. Time value erosion is calculated before, not during the weekend as it relates to Saturday and Sunday. So that's why there is little or no disadvantage of waiting until Monday than to sell the next week's weekly option. And buying back a deep out-of-the-money call option results in an unnecessary commission. So if that particular option expired out of the money, we can just let it expire. There's no charge for that, and then write the new option on Monday. And of course, there'll be a commission for that either way, whether we roll or whether we wait until Monday after the other option expires worthless. Well, there you have it. Edmond, thank you so much for that question. These kind of things are always instructive, knowing how theta works, when market makers deduct the weekend value of our premiums, and that will help assist us in getting every edge possible in making as much money as we can. So this is just one more factor that we can put into the equation as we throw the odds more and more and more in our favors to generate the highest possible returns. So Edmond, I want to thank you so much for giving me the opportunity to present this information. And of course, I want to thank everybody out there for taking the time to watch this video. Hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.